Hello, it's Rhonda Thomas, and we're about to do Managerial Accounting's Chapter 7 intro and basic exercises to get us into the chapter. Okay, I'm going to share my screen. Okay, so you should see that we have 6 problems here on the left, and I've got a spreadsheet open. Unfortunately, I didn't put these in the right order. And I can't change the order that they're in, so I'm actually going to start on number 6. If we go to number 6 first and then progress our way back to 1, I think this will make a little more sense. So let's go to number 6. Okay, there's a new variable costing income statement that you'll want to learn, and I've put that up here at the top. Okay, so this is variable costing. That's the one we need to learn first. Okay, here is our old absorption costing. And then these are some rules that we need to learn. And it would help if you kind of put this to memory, okay? I know it may sound a little weird, but there's a chance that we will get into this. All right, so let's go down here to number 6, variable costing income statement. That's what we're going to put together. This is for the month of February. Okay, we've got sales of 590,000. We're going to subtract the variable cost of goods sold, 265,500. If there was a fixed part of cost of goods sold, we would actually push it down, and it's down here in fixed manufacturing costs. Manufacturing costs are still part of cost of goods sold, but in this way, we're going to break out income. It's a little different. So we put the variables first. So it's variable cost of goods sold of 265,500. Got it right here. There's a new manufacturing margin that I am not used to yet. This is something different than I have seen in other books. Usually we would just put our 2 variables and then go right to contribution margin. So you'll have to forgive me that I'm a little out of touch with what this seemed to be doing. All right. So then we want our variable selling and admin. And remember, usually selling and admin in absorption is down here underneath the gross profit. But in variable costing, we want it immediately after the manufacturing margin. Okay, so we put variable selling and admin. I've got 64,900. Have a contribution margin of 259,600. So let's put in the manufacturing margin. Okay. And the contribution margin. Now we need to get down here to the operating income. Okay. So after we have found our contribution margin, then we're going to put the fixed manufacturing and the fixed selling and admin, and those are both subtracted from the contribution margin. So that we have an operating income of 118,000. Okay, so that is putting that together. Okay, we're going to do another one, just almost like it, but we're going to use Excel. So sales, this is variable costing income statement. Sales, 640,000 minus 288,000 in variable cost of goods sold to get manufacturing margin. Remember, that is a subtotal. So is contribution margin. Okay, and that's a subtotal. So then my manufacturing margin is 352,000. Okay, the contribution margin is 294,400. And then you subtract the 2 fixed. I got 96,000 and 38,400. And so I got operating income of 660,000. Okay, and then I know here's the open spreadsheet. So then you need to just follow along with how we got manufacturing margin. So it's equal to sales less variable cost of goods sold. Okay, and then contribution margin is the manufacturing margin that you just found and subtracting the variable selling and admin. And then finally, the contribution margin minus the two fixed amounts. And there it is. And see, we've got the same numbers. Okay. So that ought to do that. Okay, so I'm going to close that and go back to here and check my work. Okay, now let's go to when we have production exceeding sales. All right, so let's remind ourselves of the rule. Excuse me. Oh my. So it says fixed manufacturing costs are $79. Fixed manufacturing costs are $79 a unit. Variable manufacturing costs are $158 a unit. Production is $115,000, while sales are $108,100. So when this happens, when production units are more than sales units, then the variable costing operating income is less than the absorption. That's the rule. So one more time, if variable costing production is greater than sales, then variable costing operating income will be less than absorption operating income. All right, so you need to find the difference in units between the two. Let me just put these up here. Find the difference. And then we're going to take that difference. That's the difference in units between production and sales. And then we're going to take that times the fixed costs of $79 each. It's going to be $545,100. So determine whether variable costing operating income is less than or greater than. So once again, if we're producing more in units than we are sales, then variable costing operating income will be less. Okay, and it's just something you might need to kind of commit to memory. Determine the difference in variable costing and absorption costing operating income. Okay, well, the difference is 6,900 units is not going to be charged the fixed costs. Okay, so 545,100 should be the difference in operating income. Okay, now, like I said, this might be something you just have to kind of work with, because sometimes this gets a little operating income difference between the two. Okay, so it's the fixed costs that are getting moved out of cost of goods sold. Okay, out of manufacturing. Okay, let's go try another one. Let's go to number 3. Okay, so variable costing when sales units are more than production. Okay, so when sales units are more than production units. Okay. So just the opposite then, the opposite of what we were just learning, right? Okay. So what's the rule? If sales units are bigger than production units, then you look at the beginning inventory, which was 12,500 units. Okay, and we're going to take, it says the beginning inventory fixed manufacturing costs are $9 per unit. So fixed cost per unit beginning inventory units. Okay. Oop. And that's beginning inventory there. Okay. Okay. So if we take the 12,500, it says determine whether variable costing operating income will be less or greater. So now the opposite is true, right? The last one we just did, production was greater. Now sales units are greater. Okay, and we don't even know how many. All we know is there's a beginning inventory. So all of the units that were manufactured during the period and all of the units of the beginning inventory were sold. The beginning inventory fixed manufacturing costs are $9 a unit and variable manufacturing costs are $12. Determine whether variable costing operating income is less than or greater than absorption. So what they say is, and yes, this is the case, you take the beginning inventory times the fixed cost of beginning inventory units. And then it says determine whether the variable, so when sales is greater, when sales units are a larger number than production units, this is the opposite of what we just found. Okay, the opposite. So it's going to be variable costing operating income will be less than, okay, no, I'm sorry, will be greater than. So we got to do the opposite of what this one says. Okay, so you take the 12,500 beginning units times the fixed cost of those units, and the difference is 112,500. And once again, the rule is if sales are greater than, then variable costing operating income will be greater than absorption. Okay, so I'm going to make sure I'm putting this in here right. Production is larger than sales, then variable costing operating income is lower than absorption. If production is smaller than sales, then variable costing operating income will be bigger. Variable costing operating income is greater. Determine the difference in the variable costing. So to find the difference here, we were given our beginning inventory. Okay. And remember, beginning inventory in this month or period of time they're looking at, the beginning inventory was actually the ending inventory from the month before. Okay, so we have to keep that in mind. Okay, now let's go to number 2, analyzing income under absorption and variable costing. This is kind of a tricky one. There's 2 ways to get your answer. Yep. Let's put down what the fixed costs are. Okay, I got 116,800. My sales units is estimated units, sales units sold estimate, that's fine, is 5,000. Okay. So what would happen if production was 5,000 units and 7,300 units? put this over here just a little bit so I get it out of the way. Okay. So we have a 5,000 sold estimate. We have 5,000 units produced. All right. So then when you have our units produced is always divided into fixed costs. And because these are fixed manufacturing costs. Okay. Manufacturing is the key. Okay. So if we only had 5,000 units, the fixed cost per unit would be $23.36. Okay, and then if we change that to 7,300 units, and we divided 7,300 units into 116,800, it would bring their fixed costs down because you're spreading out more, or spreading out this fixed cost over these units produced. And that's why we're getting this down to $23.36 and $16. Then the difference, okay, this is how you do it. If you're going to do the difference in units, so it's the number of unit difference. There's two ways to do this, and you could check it. You can double check it. So my difference is 7,300 minus 5,000 gives us 2,300. And then we want to take 2,300 because we're talking about this one times this amount of fixed income, 36,800. Or you can take the difference in the cost, fixed cost per unit for 5,000 goes into 116,800, 23.36 times. And this one goes into, if you did the math here, this would be, you're going to actually subtract the difference in the cost of the fixed cost per unit. Okay, so this is difference between absorption costing income. All right, so this is okay, so this is saying between a plan to produce 5,000 units. So the first one, we're going to produce 5,000. So 5,000 and the amount sold will be the same. When they're the same, then the operating income on both of those are the same. But now we're going to change it. Now we're going to see what happens if we produce more than we sell. And up here, when we produce more than we sell, variable costing operating income is lower than absorption operating income. But what we need to find out is there's two ways to do this. There's a $2,300 number of unit difference. This turns out to be the variable costing operating income difference. No, this would be the absorption. Gosh darn, absorption costing income difference. Okay, so we're going to do it by the units and then take that, do it by the unit. So 2,300 units. Then we're going to take it times, okay, 2,300 units times $16. Okay, so we're going to take the number of differences times $16. Okay. So we're looking at 2,300 times 16 gives us 36,800. Here's the other way to do it. Let's take the difference in the cost. So the difference between the two costs you see there, $23.36 minus 16 is 736, but then you have to take, to get your 36,800, you have to take 736, that's the difference between the two costs, times 5,000 units. And the difference per unit is the same. These numbers must be the same. This one must be the same, and this one must be the same. Yep. So this is the fixed cost difference per unit, right? Fixed cost difference. So this is the difference between that number and that dollar number. Okay. But I mean, you have to know what to take times what. So how much would absorption costing operate income differ between a plan to produce 5,000 units and a plan to produce 7,300 units? So we're looking at 36,800. Okay. And if you're looking at variable costing, offering income different between the two production plans. So there is no difference. Okay, no difference in variable costing production. Okay. Okay, no difference in variable costing. Okay, so then the last one. Okay, the last one is actually number one, but I'm going to go back up to the top now. Okay, this is called contribution margin by the segment. And I did this a certain way in class, but I'm going to do it a little bit different on here. I think it makes more sense. So we've got absorption and we just found that one. Okay, here's where I'm at. Okay, now we're going to be looking at a segment called Atlanta segment contribution margin, Pacific segment contribution margin, where they have products, alpha and omega. Now you got to be sure to follow what's what. So Atlanta goes this way and Pacific goes this way, not across, but down. So 9,300 times $25 sale price for alpha. That's the sale of 232,500, and the variable costs are 9,300 times. Uh-oh, hang on just a minute. Okay, variable costs equal 9,300 times. Now we want variable costs for alpha, which is right there. Okay, and we want to make sure that this one is 4,200 times 8. And then we subtract. So you have contribution margin for the Atlanta. Be careful now. We just did one. Let's do both of these and then we'll do the totals. So then you need one that says Pacific segment contribution margin. So we have product alpha has 9,700, product omega has 6,700. There's a sales price of 27 and 29. which we do the math there, we get our total sales, okay? Okay, total sales. And then we're going to take that number we sold times the variable cost per unit, and we subtract, and we get 116,400, 73,700. So you could add both of those up if you want. There it is. Yep, just add across. And that's telling you how much contribution margin is being put out for each segment. Okay, 143,400 and 190,100. Now we want to know the contribution margin. Okay, so here is the alpha plus omega divided by, and we get contribution margin total divided by sales total. Okay, divided by sales total. So there it is. So if you take contribution margin total and divide by total sales, you'll get 40%. Okay, so here's what I'm at. Okay, this is sale for this is sale. Okay, so here's the contribution margin divided by both of these, right? And that's 40%. So 40% is Atlanta. Okay, and now we're going to look at Pacific region. So it looks like Pacific is 190,100. That's adding up both of those. And if we take the contribution margin divided by both sales added together, you get 41.7%. Okay, so it looks like the Pacific segment contribution margin is looking a little better than the one that looks like this segment is doing better, a little bit better. But you think it would be more better when you look at the difference in the dollars. Okay, so I think that finishes us up with the intro and basic problems. I apologize for all the confusion. Helps when I go through these. All right. I will be doing another video for the Chapter 7 coursework. I am going to stop my share and say goodbye for now. Okay. See you on the next video.